Thank you for joining us. Welcome to our webinar today. We're going to talk about how to invest in mortgage notes, and we have a guest, Lauren Wells. She's going to be sharing her expertise on mortgages with us in just a moment. My name is Larissa Greene. I'm with Advanta IRA, and I'm going to just give you a tiny little bit of insight onto self-directed IRAs, and then we'll hand it over to Lauren. Again, my name is Larissa. I've been with Advanta IRA since 2011, and I do business development, education, marketing, and a lot of networking for Advanta. So many of you on the webinar today may know me as I'm out and about and networking with like-minded investors. My contact information is here, and if you have any questions about self-directed IRAs, I'm happy to help you with them. Please feel free to reach out to me at any time. Advanta IRA and its employees do not provide investment advice or endorse any products. Today's webinar is for educational purposes only, and all parties are encouraged to consult with attorneys, accountants, and financial advisors before entering into any type of investment. So we're going to talk very broadly today about different types of investments and then more specifically mortgages. And within that sort of idea, Lauren is going to talk to us about different ways that she handles mortgages. But remember, a self-directed IRA can make many different types of investments, but it is up to you as the IRA holder to do your own due diligence and make sure you're comfortable with the investment and the person you're investing with. Advanta IRA has been in business for a little over 20 years, and we can help anybody worldwide with a self-directed account. It just has to be a U.S.-based retirement account. We've always been doing that. We have a little under $3 billion in assets under management, and we have two offices. We're in the Clearwater area of Florida and Atlanta, Georgia. But again, anyone, anywhere can have a self-directed IRA, and we can assist you with that. Something that we do a little bit different than our competitors, we offer everybody a dedicated account manager, regardless of your account size, who is going to be able to assist you with your account for the life of the account. So that's everything from just simply making an annual contribution all the way through to any investments that you'll be making. And every dedicated account manager is familiar with all asset classes, and so they can help you invest in mortgages, buy real estate, invest through cryptocurrency and single member LLCs. And so that's really what sets us apart from our competitors. If you haven't heard of self-directed IRAs, it's just very simply because most firms are not willing to hold private investments. And so we fill the gap in the industry where we'll hold anything that is outside of the market as long as it's allowed by IRS rules. And so, brokerage firms, those are great companies, great firms, but they're only going to hold stocks, bonds, and mutual funds that are publicly traded. And so we're here to help you with anything outside of that. And it can be mortgages, of course, but it could also be things like private stock, and we'll talk a little bit about what those asset classes look like. This slide is just to give you an idea of the different self-directed plans allowed, and I just like to really show this because for some reason there's a lot of emphasis on Roth IRAs. So many people think that if they don't have a Roth IRA, they can't self-direct it into privately held assets, but that's simply not true. You can see here on this slide that we talk about traditional IRAs. Of course, those are going to be the most common type of self-directed account, but it can also be things like SEPs and Simples and individual K plans for those that are self-employed, old employers plans, and then also health savings accounts and education savings accounts. And although those are not retirement accounts, they are considered qualified plans. They have, tax saving benefits, and the rules for self-directing those accounts are going to be exactly the same. And so we can help you with those as well. Before I go on, I do want to mention that these slides are uploaded in the handout section of the webinar, so you're welcome to download them if you want to save them, review them. And also this webinar is being recorded, and the recording will be available to everybody that registered, usually within 24 hours. The other thing I want to mention too is that we are taking questions throughout, so please feel free to type any questions into the question box and we'll get those answered as we go. And moving on, just very quickly, there are all types of asset classes that the IRS allows. If you would like to familiarize yourself with the rules and assets that are not allowed in an IRA, please join us for any one of our other webinars where we talk about the different deal structures we have seen and things that are allowed within the IRA account. And there really is no definitive list. The IRS basically just says you can't invest in life insurance and you can't invest in collectibles. And then there are certain people that you can't transact with, but outside of that, the sky is just about the limit. And so we like to provide just a quick list so you can really get your wheels turning and thinking about what investments you might make through a self-directed retirement account. So it can be real estate, of course, single family homes, condos, mobile homes and mobile home parks, duplexes. You can invest in syndications and private placements that invest in real estate, and the list goes on. We also have the paper side of real estate, as I like to refer to it as, where it's mortgage loans and tax liens, tax deeds, of course, and then not related to real estate necessarily, unsecured notes, but debenture notes, option contracts, typically related to real estate, assignments, joint ventures, and accounts receivable. And of course, we're going to dive more into mortgages in just a moment. And then the other truly unique side of self-direction comes out when you look at things like farm animals and movie projects. We see equipment leasing, whether it's farm equipment or things like ATM machines. We see people invest in private stock in their community. So local breweries and restaurants, local private banks, and then there's commodities and oil and gas. And like I said, the list truly does go on and on. So if you're interested in learning about any of those other asset types, please reach out to us. I'm sure we have a webinar on it, or we have one coming up, because we're always striving for the best in education. So with that, I'm going to turn this over to Lauren, and she's going to tell us more about mortgage note investing. Thank you so much for joining us today, Lauren.
Thank you so much for having me. Excited to be here and kind of present a little bit about who I am, who we are at 70, and mortgage note investing. It's not something that is, I feel like very well known or talked about, but as someone who is probably sitting in your seat, yours being the people attending this webinar not too long ago, I remember hearing about it, and that's kind of how I got into it, which I'll get to in a bit. And it's something great for self-directed IRAs. Again, so let me go ahead and kind of get started with that, because I could probably speak through all the slides on this one slide, and then I'd have to go through the slides anyway. So, so I'm going to talk today a little bit about me, who I am, my journey into real estate investing, to give some context. Then I'll talk about mortgage note investing, what it is, how it's done, and then how it can also be an active or a passive option. We'll go through some frequently asked questions, and I'll walk through a case study or two, and then Q&A. Like we mentioned, if you have questions, we'll be moderating those as well as we go. So feel free to drop them in there, and if it's something that I can answer throughout as we go, I'll go ahead and do so. So a little bit about me. Again, my name is Lauren. I actually am recovering software sales person turned real estate investor. So I actually graduated from university and went and got a corporate job, just like I was told I was supposed to do. Worked in the very stereotypical Silicon Valley startups doing software sales. And at the same time, as a former collegiate athlete, I also volunteered for a local high school water polo team and volunteer coach. And what I realized is, as I was, looking in the stands and seeing who was showing up to games, to practices, at tournaments, all the kids' things, it was really parents who were either investing in real estate or own their own business. So it kind of dawned on me then, though I didn't have children at the time, I knew I wanted children. And so I started using my sales commission to invest in real estate. Attended hundreds of webinars similar to this, real estate investment clubs, local meetups, picked everyone's brain on different investments, asset classes, and ultimately heard about mortgage notes. And what I liked about it was that it, unlike being a landlord, where you're dealing with the tenants, termites, toilets, or any kind of fix and flip or wholesaling, you were essentially becoming the lien lord, is what we say. You're assuming the position of the bank, but your investment is secured by a physical real estate. So I was really attracted to it for that reason. I also loved that there was a lot of creativity that went into it. It wasn't just I buy a house under market, I fix it up and I sell it, and that's like, the method. Or I'm gonna hold something and cash flow, buy long-term rentals, or whatever it might be. There are multiple exit strategies when you're working notes. So that attracted me to it. I then met my current business partner now at a conference. And together we've managed over 600 deals together. So we like to say we fix and flip mortgage notes. And we built our own portfolios. We realized then, as we were doing these joint ventures with individual investors, a lot of self-directed IRA investors, cash investors, that not everyone has access to these types of investments. Typically they're, siloed to ultra high net worth, accredited, or family offices. You're thinking BlackRock, Blackstone. So that's how we started 70 Investments, really to make this exclusive asset class available to the masses. So kind of talking about mortgage notes. Again, not something you hear every day, but something you're probably familiar with. So most people maybe sitting on this call, if you have ever owned a home, you might have received a letter in the mail that says, hey, your loan has been sold by JP Morgan to Citibank, and now send all your payments to Citibank. So that's essentially the sale of a mortgage note. And banks on average, this is an interesting fun fact that I actually just learned, is if you were to hold a note for the full 30 years, for a 30-year loan, it would be sold an average of 7 times. Now, most people, the average time they hold a loan is 3.5 years because they'll refinance, they'll sell, whatever that might be. But this just shows you that notes are being constantly bought and sold on the secondary market consistently. So, this is a huge market. There's about 13 trillion in single family residential debt. And when I talk about mortgage notes, my area of expertise is single family, the single family world. So I, don't have much experience in terms of commercial or multifamily outside of, 1 to 4 units. So keep that in this context. That's what I'll be speaking to. So massive industry, and anywhere from 250 billion to 500 billion is floating around in non-performing debt. Now, I'll kind of clarify what the difference is between performing and non-performing here shortly, but this just goes to show you that when you look at market and you're looking to invest in an asset class, you always want to look at what's the size of the market? Where's the opportunity? And so just showing that, where we are now, there's massive opportunity and inventory in the mortgage note space. So what is a note and a mortgage? I think, and even myself, when I'm speaking about this, I think sometimes people use this interchangeably. So the note, when you go to buy a home, you're actually signing 2 documents. And there's the note and the mortgage. So the note is really the loan, the promise to repay. It has the specific terms. It says you're paying, your interest rate is 6% over 30 years. Your monthly payment is this. It's your IOU. And it's secured by the mortgage to the physical property, so that single family home. The mortgage is the legal document that you're signing that secures the note to the property. So that in the case of default, the mortgage gives the lender, the bank, the right to collect using the property as collateral. So going through that foreclosure process. The mortgage is actually what gives the bank the right to go through that foreclosure process, not the note. Excuse me. I think I'm coming down with a little bit of a cold, so bear with me if I sound a little off. Mortgage note investing is really an alternative investment strategy that is secured by physical real estate. Note investors are buying loans from private banks, credit unions, hedge funds, other funds, whole loan traders, and they're buying these at a discount. And I'll talk about why in just a second. And they're assuming the position of the lender. They're becoming the new lender of record as long as they hold the note. And what they're purchasing is really the rights to the future mortgage payments. So when I got into this because I thought, great, I can purchase performing or non-performing notes. I'm going to get on the performing, I'm getting that monthly cash flow. And on the non-performing, I can either go to foreclosure or get them re-performing and sell them back on the secondary market for a profit. And so I'll kind of walk through that strategy here. So I've mentioned this a few times, performing versus non-performing. Performing is really when a borrower is meeting and paying per the terms of their agreement, and every month they're paying their mortgage, there's no delay, it's on time as expected. Typically, when those are purchased on the secondary market, you're purchasing them for anywhere from 60 to 90 cents of the outstanding balance. So if there's a loan for 100K, you're getting it from anywhere from 60,000 to 90,000 as an investor. And I do talk about why later on, because that is always a question we get. So I will answer the common FAQs on that shortly. Non-performing. This is when a borrower has is 90 or more days past due. So they're in default. The first 90 days, they'd be considered kind of semi-performing. After 90 days past due, they're considered non-performing. So those are typically purchased, as you can imagine, for a steeper discount, anywhere from 40 to 60% of the outstanding loan balance. So you're looking at that 100K note for $40,000. With the collectible balance still being 100, you only paid 40 for it. Just to clarify, you're not buying a loan for 40 and then its value is 40. So how note investing works, and this, I like to say we fix and flip mortgage notes, because really, I think the fix and flip model is something most people are familiar with. You might have watched one too many HGTV shows about fixing and flipping. So it's a similar concept, but we apply it to mortgage notes. So buying loans on single family homes at a discount. So this is the purchase. This is where you're getting those loans below market value, whether they're performing or non-performing. And then there's really two different kind of exit strategies here. And the top is the one I want to walk through. That takes into account probably 95% of, like, in my experience, my portfolio, our portfolio as a company, and that is negotiating a payment schedule with the borrower. We do talk about, again, common misconception, people don't wake up one day and decide I'm not going to pay my mortgage. Typically there's 4 categories of reasons why people have stopped paying. And during the purchase process, it's similar to buying a home. So when we're buying these loans, we're doing a thorough due diligence process. We're looking at the borrower, the title, we're having a lawyer go through everything, making sure it's collectible, not outside the statute of limitations. We're verifying the property value. So all of that is done before we even purchase the loan. So we're looking at a borrower's both desire to repay and get back on track and what happened to cause them to go into default. So once we onboard these loans, we do send, the first thing we do with all of our loans is we'll send what's called a demand letter. And if you're familiar with the foreclosure process, that's really the first step in the foreclosure process. Now, the intent is not necessarily to foreclose. It is to get the borrower to come to the table and negotiate with us. As we purchase this at such a steep discount, there's a lot of flexibility that we have in working with the borrower. Now, keep in mind, this only applies to non-performing notes. Performing are just notes that we're purchasing at a discount that provide us with that consistent cash flow. Now, what we'll do is we'll say, okay, Mr. Borrower, we sent the demand letter, they come to the table, they say, I was out of a job, then I fell behind, you go to the bank, they have no flexibility, they're gonna apply any current payments to past due, and it's kind of a snowball effect. What we're able to do is we will say, great, can you make your monthly? And they'll say, yes. We'll go ahead and do a trial payment plan with them for 6 months. So this borrower will continue to pay their monthly PITI, excuse me, for 6 months. And then we're generating cash flow from those payments. And at the end of 6 months, we will modify the loan. So they may say, be 30,000 past due. They've made those 6 monthly payments, and then we'll come to some sort of agreement with them. Either we will recast the loan, meaning we will extend the term and add that 30 to the end of the term, or we will, in terms of like, it'll just extend it, X number of years, or they'll say, hey, I can actually make quarterly payment plans towards my arrears for the next 3 years until I'm caught up. So there's multiple, and this is something I love about it, is there's multiple different ways to kind of structure that modification with them. We also have borrowers who have not significantly horrible credit. So we might say, hey, you might want to refi. This is an option for you. And then the exit options here, you can see is selling the loan as performing back on the secondary market. So if we bought that as a non-performing loan for $50,000, we get it to what's called performing status, we can sell it back on the secondary market for, and again, anywhere from $60,000 to $90,000. So we're making, that's the flip. The borrower might also sell the home and pay off the loan, or refinance and pay off the loan. When they say pay off the loan, we're collecting that full balance of the loan. So we may only have paid 40, but we're still gonna get the full balance of 100. So that's kind of where that flip is. Not only are we collecting the cash flow payments, but we're getting them reperforming, and then we make a bigger profit on the sale. The other exit strategy, which takes into account about 5% of our portfolio today, is taking ownership of the home. And so, again, going through that foreclosure process and then exiting it, either we're paid off at auction or we take back the property and sell the home, which is very rare, as you can imagine, this economic climate. So I talked about this closely, but I think it's really important to kind of look to see if you're interested in investing in notes, what it looks like to do that whole due diligence process. So it's, again, very similar to buying a home. You get a list of, it's called a tape, glorified Excel spreadsheet essentially, that has all the loans, all of the information, the current due, past due, next pay date, value of the property, property address, borrower information, and within probably about a few days, you give an indicative bid. This is typically based on yield, which is why we're interest rate agnostic and not really affected by the ups and downs of interest rates. So to give an example, if we are looking for a 12% yield and the loan was written at a 6% interest rate, we're going to need a 50% discount. If it was written at 3%, we're going to need a 75% discount to make those numbers work. So we give our indicative bid, the borrower will, or the seller will accept or reject our bid or offer a counter bid. Once we come to an agreement, we'll enter a escrow or due diligence period where we do a deeper dive into all of the assets. Again, looking at title, verifying property value, because obviously that is a big factor in how much equity we have. Looking at the borrower information, their history, their criminal, their credit, all of those things. And then depending on what we find, we might fade the bid, we might pull out of some notes if property value is misaligned, and then we'll close on the notes that we do decide to acquire. So there is a due diligence period. It's not like we're, hey, these notes look great and just onboarding them. Now, 3 of the things we look into are the property, the person, and the predicament. So in that due diligence period, like I mentioned, we're looking at title, we're looking at the structure and the value, getting eyes on the property to make sure that it's actually in good condition and can live up to the value that the seller provided. Again, trust but verify. We're making sure it's a first position lien. We're making sure that taxes have been paid. Are there any outstanding tax liens on this? All things that are important when it comes to the exit strategy and what we aim to make. We look at the person. So we run a skip trace on them, meaning we're pulling their financial history, criminal history, and their payment history. And then we're looking at the predicament. And this is really what kind of, I think, sets us apart, is we're actually reviewing servicing notes of the prior lender to make sure to see, and this is something I would recommend wholeheartedly, because again, people don't typically just wake up one day and decide to not pay their mortgage. Most people fall out of payment because of one of these 4 things: death, divorce, job loss, or some sort of situational incident that came up, life event, and then they get so far behind and the banks have no flexibility to work with them that there's no point in them getting caught up. They'll always be considered non-performing or behind. So lots that goes into it. There's also, as an active option, there's also passive options. So there's mortgage note funds, which essentially you're, as an investor, you're doing due diligence on the sponsor, in this example, 7E, or whoever that sponsor is. The funds allow you to have the potential for passive cash flow without the headache of going through the due diligence, managing the servicers, making sure you're within the specific regulations of each state because you are a debt collector. There's profitability and varying market conditions with mortgage note funds. So note prices really fluctuate in terms of supply and demand. So what was interesting is during COVID, note prices were at an all-time high because values were so through the roof, and government funding was being paid to people, so they were paying their mortgage. We didn't really see a lot of default. Well, what's happened is, in a downturn market, which we're in now and probably will be in for quite some time, note prices decrease. More people are defaulting, more banks are trying to have liquidity available, so they're selling portfolios, which has allowed the market to readjust, and note prices have declined and allowed for more of a, hey, I can actually cherry pick now what notes I want, versus having very little availability and kind of fighting with other buyers for certain notes that were overpriced and charged at a premium. So they're also collateral. Notes are, you're investing in a fund that is backed by specific collateral. In this case, you know, in our case, it's single family homes. In some cases, it could be like, again, multifamily, commercial. And then there, like I mentioned, the versatility of a note fund. There's numerous exit strategies, and then you're not really tied to a specific note. You're tied to the outcome of the portfolio as a whole. So rather than investing in a single asset, you're tied to the portfolio as a whole. So it's, if one asset loses, you're not out, you know. So some frequently asked questions and case studies. So this asset class in this economic environment, this comes out a lot. And I'm sure if you've been reading the news the past 6 months, everyone has a credit fund these days. Everyone has, you know, a debt fund. And it's because, you know, credit is preferred due to rising interest rates. Now, one thing I always look at when, you know, everyone kind of flocks to debt funds is, okay, is that debt fund a standalone debt fund, or is that debt fund funding something else? So something to take into account. Again, I always like to educate just in general on sponsor due diligence, or, you know, because these are your hard-earned dollars, and I think it's important to understand questions we can be asking of sponsors as someone who was sitting in your seat, again, just less than a decade ago. Inflation is going to lead to higher mortgage defaults. You know, student loans as of last October and a lot of government intervention and subsidies were pulled, which, you know, now people's savings are dwindling if they had any savings. And so we are seeing record defaults. So lack of inventory in the housing market. A lot of people think mortgage notes, they hear, oh my gosh, PTSD 2008. So this is a very different situation from 2008. And really in 2008, people were walking away from homes. You know, they were underwater, but they could rent next door. And right now we're seeing a lack of inventory and inflated rents, which is causing more distress, but it's also having more borrowers come to the table because they're looking around and they're saying, okay, my mortgage might be $3,000 for a 3-bedroom, 2-bath, but if I try to, you know, if I lose my home and I have to go rent somewhere, I'm going to be paying $3,000 for a 1-bedroom, 1-bath. So, or a 2-bedroom, 1-bath, and it might be an apartment, not a standalone home. So they're more incentivized to come to the table and work with us as a lender. And then equity. There is equity should there be a dip in the housing market, because these assets are purchased at a discount. So for example, I wouldn't look at anything that doesn't have at least a 65% loan to value, then you're taking a discount on that. So right now, to give you an example, the portfolio we manage has a loan to value of 30%. So there is significant equity coverage, even if the market were to drastically course correct. And then banks are really focused on liquidity. Everyone saw what happened with Silicon Valley Bank, which kind of sparked a little bit of nervousness within the banking industry. And they're realizing, I'm going to sell performing assets because, actually, I'm going to get to this in a second. But they're focused on liquidity, which is leading to more inventory flooding the market, and in turn, a lower acquisition cost for those people who are looking to invest in mortgage notes. What motivates sellers? So banks, again, looking for that liquidity. They want to get non-performing notes off their books to rebalance their books. I always like to say banks are really good at creating debt. They are really bad at managing it. I don't know if anyone's ever tried to get on a phone call with anyone at their bank. First of all, just trying to navigate the automated system and then get an actual person, let alone for a simple issue, is hard enough. Imagine if you were trying to talk to someone about your loan with them, what that would look like. So they're just not staffed to manage non-performing assets. For them, selling at a loss and writing new paper, new quality paper, meaning a good loan at 7%, is much easier than managing a non-performing asset that they probably won't see a return on for, if they go through the foreclosure process, for anywhere from 18, 24, 36 months, depending on the state. When they have too many non-performing assets on their books, it impacts their ability to lend to more qualified borrowers. And then when you talk about why would they sell performing loans, they're paying, well, rates a few years ago were at 2%. Now we're looking at 7%. So they might have a ton of loans at 2 and 3%. And yes, they might be paying, but as we all know, they're still losing money on their loans. So they can still, again, sell those at a discount And yes, take a little bit of a loss, but then take that money and write new paper at 7% so that they're in line with market. And then lenders on the secondary market are looking to sell because they're either closing their fund, they want liquidity, assets might not fit their buy box, or they're looking to rebalance their portfolio. What causes distressed debt? Now, again, this is probably the biggest hill I had to climb when I first got into this, was I don't get it. I was always taught if people didn't pay their mortgage that the bank is going to come take their home within like 90 days, they're out. Most people, one, that's not really how it works, as I've learned. This can be a long, arduous process, which is why most people ask, well, why don't you just go through foreclosure? You know, honestly, foreclosure is not always the best option it's not the best option for the borrower. It's not the best option as an investor because it's long, it's costly, and it isn't the best. It's a lot easier and you get a better return on your investment quicker, so your IRR is higher, by working with the borrower. And what we found in doing this over 700 times, 600, 700 times, the fix and flip process, is that it typically comes down to one of these 4 things that causes people to fall behind: job loss, health issue, a divorce, or a death. And I kid you not, every time we see one of those things, what happens is they try to go back to the bank. In some instances, which I'll talk about later, the bank actually was offered by the borrower some sort of modification and the bank just didn't get back to them in time, which is an easy win for the person who purchases the note. So this is a case, we'll talk through 2 case studies. This one is a little bit of an anomaly, and the next one we'll talk about is our kind of bread and butter. So we purchased this in July of 2022 as a non-performing loan that was 10 years behind. Borrower is completely non-responsive, and the prior lender wouldn't be able to foreclose because there was a title issue, which we caught during our due diligence. So we acquired the loan after the seller fixed the title issue, and they were forced to sell because they were closing their fund. We filed foreclosure in July of 23. The court actually required mediation, which resulted in working with the borrower and the state. And the state actually contributed. A lot of states actually have HAF funds, so housing assistance funds. The state contributed $50,000, and the borrower actually started making payments in January of 2024, and he has made all his payments to date. So in this case, it was really, he was so far behind, and at one point it just spiraled out of control and he was not going to get caught up. This allowed him to get caught up. To date, we received, $53,000 in payments with additional $15K in costs. So we're going to look to sell this loan in this quarter of this year. And so kind of just to talk through the numbers, the past due amount was 205, or the total amount, was 200,000 owed. The past due amount was 110. We acquired this for $80,000, and the value of the home was 274. So again, ROI of over 55% at this point. One more case study if I can. Oh, okay. And this one is really more of our bread and butter, I like to say, and an example of how banks are really bad at managing debt. So this, came to us. The total amount owed was 150,000. There was a past due balance of 23,000. So, just under 200 there total owed. We acquired it for 100K, and the value of the home was 400,000. So it's considered non-performing. Interesting story here is the prior lender really did minimal effort. They drafted the demand letter, they never sent it. They took 9 months to respond to a loss mitigation package, so what happens is when a lender is trying to work with you, we do the same. We send a loss mitigation package asking for the borrower's financials, what they can afford, everything you would need to qualify for a loan, essentially. The borrower got it all together, and the lender never responded. So we acquired this loan in May of 23. The borrower offered us the same deal that they offered the prior lender, 4K in July, 3K, and then 3K with $1,000 extra monthly payment starting in August. Due to lack of progress, we actually did send a demand letter. They agreed to sign our trial payment plan, which included the down payment of $3,000 plus increased the monthly payments by $1,000, so $2,000. The trial payment plan started in December. The borrowers made all their payments to date, and we are looking to actually start selling that loan. So we recasted it with a loan modification. We estimated resale value right now is 140,000. Again, so not only are we collecting that 3,000, those monthly payments, we only bought it for 100. So you can see that resale value, because now it's considered performing, they're caught up, is significantly higher. So now I kind of want to open it up to Q&A. I know I threw a lot of information at you guys, but I'm always more than happy to ask questions about mortgage notes, how I got started in this, anything about me, our fund, whatever you're interested in learning. I'm pretty much an open book. Things you should ask sponsors when you're looking to invest. So again, I'll kind of leave it up to you, or we can end it here if there's no further questions.
So Lauren, I have a question for you. I know that you mentioned bidding on the notes, and I have heard in the past from other people who purchase non-performing notes that oftentimes they'll buy them from a bank sort of like in a group. So they're buying kind of what they think will be successful versus unsuccessful, all in a group of notes. But it sounds to me like you're doing it a little bit differently. Can you explain that a little bit more?
Yeah, so we do, so it depends on the seller. Some sellers will let you what we call cherry pick, meaning, hey, I'm gonna pick, the ones that fit my buy box or the ones that look, to me the best. We do that. There are, however, some sellers that don't allow you to do that. You have to take down the entire tape. And that's where you're gonna get better pricing typically, because there are gonna be ones that don't make sense. So you can kind of adjust your bid and get a significantly lower discount on those, and so therefore the portfolio as a whole. So it's really just seller dependent. We do both. It just depends on who we're working with, obviously what that whole tape looks like. If 90% of them are trash loans, and don't make sense from a return perspective, we'd probably pass. But if it's a tape of 100 and 6 of them look like they might not yield a significant ROI or might have to be sold to someone who does, for example, we had a tape with like 4 loans in Montana. We don't do business in Montana. So, okay, we're going to sell those immediately and flip them essentially as is. So it just kind of depends on what the tapes look like and what the seller will allow for in terms of will they allow you to cherry pick or not.
Okay. And do you just simply get on a list somewhere with a bank so that they notify you? How does that work?
Yeah, so when it comes to getting on lists and kind of where to buy, the best place to start if you're an individual investor, especially direct investing, for the first time in notes, is there's a bunch of groups with whole loan traders that send out, hey, these are for sale. If you're interested in that, feel free to email me. I can put you in touch with our asset management team and they'll have that for you, of who would be the best contact. And they'll send out, again, they'll be the ones to send out, hey, here's a tape for sale. Bids are due this day. And then as you build credibility essentially in the space, if you're looking to go beyond, 1, 2, 10 notes even, if you're looking to build like a larger portfolio, then you will be able to start getting in contact with, banks, credit unions, whole loan traders. But then the reason I say that is there's a lot of liability when it comes to purchasing a note, as you can imagine. So if you've never done business with a larger institution, they might be cautious because it comes back to them if you don't follow the rules of engagement with debt collection. So a lot of this industry is really built off of relationships that you've built and credibility on, one, following and adhering to debt collection rules, because again, you are considered a debt collector when you do become that lender of record, and ability to close on when you say you're going to close on a note, meaning fund.
Okay, got it. Okay, great. Thank you so much for that.
Yeah.
We had a few questions pop up specifically about 7E and Lauren's company and fund. I don't want to address those here, but you are welcome to reach out to Lauren. We can go back to, is it the first slide with your contact information, Lauren?
I think it's at the end. Let me see.
At the end, okay.
Yeah,
go ahead, I'll let you. Do you control it? And so, oh, there you go. Okay, so you can, if you have questions about the fund or what Lauren does, please reach out to her. We don't want to address them here, but you are welcome to reach out to her. And then there are some more questions for you. One of them, Lauren, somebody is asking, are there any tax advantages to this investment?
So that's really dependent on I'm not gonna go down the tax rabbit hole. When you're investing in notes specifically, I would consult with your, CPA, and there are some potential tax benefits with our fund, but like mentioned, if you have any questions about our fund, feel free to reach out to 70 Investments. I have our invest email there, but you can also email me directly, and it's just lauren@70investments.com. I'd be happy to answer any questions that are specific to the fund. I think an interesting way to see kind of what this looks like, because I always remember, again, attending these webinars and seminars and being like, well, like, what does this look like in practice? Is we do send out a weekly case study talking through like, hey, these are the figures, this is what happened, this was the outcome. So if you're interested in kind of learning more just from an educational standpoint about what this looks like on a kind of one-on-one basis, we do have, again, you can join our newsletter. We just send out a weekly case study. It's not like a inundate you with emails every day kind of thing, but I think that people who are looking to get into this from passive or active option, it's just good to see the wins, the losses. We also talk about due diligence. So you can, on our website, I think there's a place to join the newsletter as well. So you can do that there.
Okay, great. And there's another question about validating the property title. What's important, or what is there to know about that? And I'm sure that could probably be a whole webinar in itself, but maybe if you could kind of just give us the gist of what you look at.
Yeah, so when you're looking at title, you want to make sure, is it actually in the borrower's name? So for example, when my husband, several years ago, I was essentially not on the loan, but I was on title to our house. So my husband was the party responsible, but I was still on title with my husband. So things like that, you want to make sure, which is fine if they're paying. But for example, I was not on the hook for those few years, and my husband and I always joked about it. He was on the loan, I wasn't on the loan, but I still was on title to the house. So just making sure that who's on title in the mortgage and the note is in alignment, especially if it's non-performing, to know like who the borrower actually is. Making sure that is a first position, making sure lien position. So for us, it's investing in first position liens. Sometimes we'll find that a lien on a tape says it's first position, it's actually second, because there's another loan that showed up that wasn't, listed on the seller's tape. Looking at making sure taxes are paid, because taxes do supersede first position liens. Again, just making sure that what's been recorded with the county, who is on title, actually is matching. So worst case things that you could find is, okay, well, the person who's living in the home paying this mortgage isn't even on title. And that could be an issue, because if your borrower isn't paying, they're not on title, you really don't have any access or rights to that home. So it's really doing research with the county to make sure that, again, who's on title matches who is, paying the loan.
Got it. Okay. That makes a lot of sense, really. And when you're kind of new to this, it wouldn't even have occurred to me that whoever's living in the house might not be the borrower. So that's very interesting.
Yeah, it could just be sometimes and it's like, oh, the prior lender never recorded it with the county, and it's like mind blowing. So just again, another example of how just a lot of this business is very like customer service, being on top of it, and knowing how to work with people, knowing how to make sure that you're very organized and detail oriented. Because sometimes we do find, oh wait, that person's not on title, and we'll go back to the seller and they're like, oh, we just actually never recorded it. So we'll say, okay, we'll record it, but we're gonna fade our bid, or we won't purchase it until it's recorded with the county, which doesn't take long, but again, sometimes just gets forgot.
Okay, that makes a lot of sense. Well, I don't see any other questions. So again, I would encourage you to reach out to Lauren if you do have any more specific questions for her. Lauren, I want to thank you so much for joining us for this webinar today. And as a reminder to everybody that joined us, this is being recorded and we will share the recording within 24 hours. It'll be emailed over to you. Thank you so much, Lauren.